Right. Let's start discussion on a very important topic for the senior analyst role in the development financial institutions like NaBFID, Exim Bank, or the NABARD Bank or the SIDB. But these are the specifically for the NaBFID role. So here we are going to discuss on the financial structuring and monitoring for the infrastructure projects. So, guys, it is at the most important topic for the risk management team, or the you are looking for the role in the senior analyst or the analyst role in the development financial institutions like NaBFID. So let's move on the topic, guys. Before moving on the topic, I would like to request you guys, if you are new to my channel and if you are serious about your career, and if you are serious about to increase your salary and to move from the or the private organization to government sector, or to move to the IT industry as a business analyst role, or the quality analyst role, or the quant analyst role. So please do like and subscribe my channel, because I am continuously creating on hot topic videos that the interviewer might chance to ask this topic in your interview, so that will help you to get the better opportunity in the different organizations. So let's start discussion on, guys. So let's discuss on the agenda of today's topic. Here we I'm going to discuss on the NaBFID mandate of the infra project characteristics, and what the analyst should understand, and what are the NaBFID and why the NaBFID is created. That thing we are going to discuss. Then the financial structuring framework. We are going to look at different financial structuring and their framework, how they involve, and what are their roles in the NaBFID development. Then we discuss on some key risks and allocation mechanism, like construction risks, operation risks, or the revenue risks. We discuss regulatory risks, financing risks. So each risks we discuss there, and then we discuss on the capital stack and the credit enhancement, how the NaBFID will help to the lender to in the perspective of the capital enhancement and the credit enhancement. Then we discuss on the project monitoring, like a construction phase and the operation monitoring phase. So each phase, pre-sanction, post-sanction, and the during the sanction. So these three phases, how that will work, we are going to discuss that thing. Then the NaBFID specific consideration and the senior analyst key deliverable and the skill sets has an senior analyst must needed, and you should learn these skills by putting your efforts. So let's discuss on NaBFID mandate and why structuring is matters for the NaBFID. So the NaBFID set up under the NaBFID Act 2021, and it is the Parliament passed this act, and so the act is called as a National Bank for Financing Infrastructure and Development Act 2021. The bank specifically created by the government of India for the long-term infra financing, and to create a bond, to develop the bond market in the India or out of India, and to facilitate the public-private partnership projects. So all the kinds of the infrastructure project, you should go on RBI and check the harmonized list for the infrastructure projects. So recently, the data will be the one of the key infrastructure where that will be facilitated. So the road construction, port construction, airport construction, or the water management, renewable energy management, these kind of the infra projects where need a huge amount of investment. So that's the investment need will fulfill by the bank. That is the NaBFID bank. The government will create it. So the infra projects and the unique trade. So guys, it is on the high capex. It should understand the infra projects are high capex, long duration, and under the construction period there is no the principal inflow of the principal and interest rate. So you need to keep in that mind. The such kind of thing are not done by the commercial bank like ISBI or the HDFC, ICICI, Canara Bank, or the Union Bank, Central Bank. So that banks are the commercial bank. That's not do some kind of such kind of the lending to the borrower. So that's why the NaBFID is created. Then the long gestation ring facing financing, the back end cash flows, so that there is a cash flow issue, multiple stakeholder involvement in such projects like the authority, EPC contractor, operation and maintenance contractor, lender, borrower, sponsor, or the different kind of the stakeholder are involved in such kind of project. Or the different banks, different 5 to 6 bank inter creditor agreement is there, concession agreement is there. So there are the different regulatory are involvement, disco are involvement. So such kind of stakeholder, multiple stakeholder are involvement or required to involve in such kind of project. So this makes the unique thing of that project. So then exposed to regulatory policy and the demand risks. Yeah, it will be to align with the regulatory policy. What are the going to changes in the regulatory that need to be analyzed by the analyst, and also what are the limits, regulatory limits for the particular industry, what are the individual limit, what are the group limit, what are the portfolio limit, that need to be understand, analyzed and implemented by the analyst and the senior analyst. Then the policy is created, demand the risks, understand the risks, revenue risks, traffic risks, gap analysis, sensitivity analysis, stress testing, that need to be used and demand in this the infrastructure financing, and that need to be done by the NaBFID. Then the senior analyst role is a structure bankable deal. So the senior analyst is a key role is to structure and the bankable deal. So that should be a commercially and financially and technically feasible deal that should be generate the revenue for the banks, and that will be helpful for to develop the infrastructure project in India. And that should be recover the investment amount and back to the investor in the infrastructure product, like the external commercial borrowing, pension fund, insurance fund, or the intermediary entities or the government funds. So and assess the viability, monitoring performance, continuously monitoring performance of the project, and attract the lender independent report, site visits, done the site visit and analyze the progress of the project, also do the actual progress of project and the predicted progress of the project, and do conclude that thing, update the higher authority of the banks or the project sponsor or the intercreditor banks to the growth of the projects, to check the trust and retention account, to check the escrow account, to check the entity the SPV account, and to check the progress of that account. So that's the role of the senior analyst. So let's move on the next slide, guys, where we are going to discuss on the financial structure processing. So how the financial structure will look like. So there are a two steps. First one step is a due diligence, and second step is a financial model validity. So in a first step, we are going to review and analyze the technical, commercial, and legal due diligence. In a technical due diligence, we are going to check what kind of technology they are using, what are the impact of that technology on the project. If with that technology, is that project is feasible in the terms of the commercial or the budget, or the technically feasible. Okay, what are the new technologies in the market, the cost of that technology. So that's we do. Then we check the EPC contractor, engineering, procurement, and construction contractor. Who are the engineering contractor, who are the procurement contractor, who are the construction contractor, how much the budget they have, is it an individual person, or all these three are a different person. For different kinds of the contractor we are going to involve in that project. So that need to be analyzed, and to check the history of that the contractor and their the records. So how much they deliver the project, is they delay, that thing is changed. And the implementation phase. So each the implementation phase, what are the tracking done, and what are the progress, what are the milestone of that infrastructure project will achieve in the each implementation. So that should be analyzed by the analyst. So like the origination, then the agreement formation, then the allocation of the contract, then the construction phase, then the lending phase, and then the finally the commercial phase, or to the operation phase will start. So that's each stage. And lastly, the closing phase, or hand over that project to the government. So each phase will be looking by the analyst, and what are their agreements, what are their terms and conditions for that phase. So that need to be reviewed and analyzed, and proper credit note document or the credit appraisal document will be created by the analyst. Then the commercial, so off-taker and concession agreement, or the check the agreement, PPP, power purchase agreement, or the public power partnership agreement. What are the each roles and involvement in that projects, or the skin in the game, how much the equity are involved by the equity holder or the sponsor in that project, or the return, internal rate of return that generated by that the project. Then the traffic demand assessment, how the demand, to do the traffic and the demand analysis, stress testing, scenario analysis. If suppose as per the demand, if demand is below the 10% or the 20%, what are the impact on the debt service coverage ratio? So to project life loan life coverage ratio or the project life coverage ratio. So to do analysis, to stress testing, scenario analysis, and gap analysis on that thing. What are the to be process? What are the hedges process? Then the legal thing. So it is, and the most important thing, guys, the land before lending to the finance to the sponsor or the borrower, we need to track the land clearances document. More than the 95% land will be acquired by the sponsor. Clearances, different environmental clearances, social clearances, government clearances, or the all the government bodies that involved in to complete that project. So from that, the clearances document or the clearances document will sign and approve from them to check and verify this document. Then the concession agreement and the enforceability of contract and step in the right. So it is and the most important. In case suppose the project sponsor are not able to complete the project and are not able to do the repayment of the principal and interest rate, so the lender have rights to step in the project at any time. So that's the made of that step in the rights. And then in the second phase, for the second step, we will do the financial model and viability. So where we build a three statement model and detail the assumptions, to write down all the assumptions, all the risks that, and what are the techniques we are going to use in the risk mitigation, risk analysis, and what will be the assumption of the post construction, pre construction, or the end of that project, handover to the government of that project. So all these assumptions we write. Then the output, the projected internal rate of return, equity rate of return, debt service coverage ratio, loan life coverage ratio, and PLCR. So the average debt service coverage ratio should be the greater than 1.2 and x, and the minimum it should be 1.8, and the loan life coverage ratio should be the 1.3x, and the project life coverage ratio should be 1.35x, and there is a tail period should be greater than 2 to 3 years. It is and the most important thing, guys. The tail period is nothing but the life of that project and the loan life. So minus the life of that project minus the loan life, it should be greater than 2 to 3 years. So that will be considered as a good project. So that's, let's move on the next slide, guys, where we are going to discuss on the risk type description and the risk mitigation. So key risk allocation in the infra project. So there are the different risks like construction, revenue, demand, operation and maintenance, regulatory, financing, force majeure, or these are the risks. And let's, construction risk is occurs between due to the cost and time overrun, not able to achieve the milestone within a time. So and the increasing the external factors like operating raw material cost is increasing, manpower cost is increasing, availability of resource, machine, material, so that cost is increasing. So that's the description. And where we need to mitigate the technique of the construction risks, we use the fixed price EPC, engineering, procurement and construction contract. We'll write down the LDs that will help us to mitigate the cost overrun or the construction risks, and the contingency and parameter support we do for the different parameter and support this thing. Then the revenue demand, so traffic and the tariff risks. So there are the traffic risks or the tariff risks is we as we predicted, on that road daily the 1 lakh bike will pass. Is that the feasibility of that bike will be passed? To predict that thing, to do the traffic analysis, how much the daily, monthly, yearly, quarterly, annually revenue we generate from that project. So the mitigation technique we use for the annuity, hybrid annuity model, it is and the most important technique, and mostly the hybrid annuity HEM model is used where the 60% of the funds from the authority or the government and 40%, sorry, and the 60% from the lender and the borrower. So that's the hybrid annuity model. So viability gap funding, VGF or the grant. So if suppose the project is a the technical feasible or the commercial is a good, but the financially that project is not good. So in such project, the government will give the grant for on that projects, and so the lender or the borrower or the sponsor will get increased interest in that projects, and they will take a bid, and they will on the basis of grant viability gap funding, they will acquire that project and complete, and they don't need to pay that amount in the form of principal and interest, the viability gap funding. Then the take or pay, escrow account, trust and retention account is there. So there the payment mechanism and all these things there, and fund flow will happen. Then the operation and maintenance risks, which are the most important risks, guys. The performance cost hike, or the machinery cost, or the maintenance will require for that project. So the operation and maintenance contract with the KPIs, key performance indicator, and maintain reserve account. So we need to maintain the major maintenance reserve account. So where the some funds are kept to in case of the urgency in the maintenance will require, or the then the risks, next risk type is a regulatory risk. Regulatory risks are most important risks, and it is an unpredictable risk, or it is not the the predictable, and it is the flexible or the dynamic risks. So change in law, approvals, continuously change in law, we need to change the documents, we need to change the approval, we need to change the process as the regulatory will define. So SEBI, the RBI, the IFRDA, Insurance Development Authority of India, Pension Fund Authority Development of India. So these are the regulatory that will define their rules and regulations, and to run the Indian financial system smoothly. So we need smoothly. So we need to adopt the changes and implement that changes in the projects. So the compensation clauses in the commercial agreement, or the political risks and the insurance, so that need to be measured. Then the financing. So guys, the financing risk type is the most important risk types, and we need to more focus on that risk, like the operation risks, liquidity risks, credit risks, market risks, that will be impacted on your project cash flow, or that will be impacted on the growth of your project, or the upcoming disbursement. If disbursement is coming, so you should have the funds to pay the disbursement. So interest rate, refinancing risks, change in the forex market, change in the commodity prices, change in the the equity market prices. So that's need to be comes under the financing. And debt sculpting, how much the senior debt, how much the mezzanine debt have, how much the the different kinds of debt in that project should have, and what are their mechanisms, payment mechanism, interest cap, and the takeout financing, refinancing of that project. So these all things are the financial risks in the infrastructure projects, because the infrastructure projects are the duration in 15 to 25 years or the 30 years. So that's why we need to refinance the project. Then the force major, so natural and the political event that can be affect the projects, or that can oppose the project to success within the time frame or the allocated budget. So in that case, we need to use the mitigation techniques like insurance, termination payment of authority to collect the funds, or to add the clauses of the force major, stronger clauses of the force major. If the force major will happen, who is the responsible, who is the financial responsible, who is the commercial responsible, who is the technical responsible for that projects, and how we eliminate it, what are the costs we need to bear, who is going to pay that cost. So that need to be right in the assumption section, with the strong assumption section, and we should have the strong insurance in that case. So let's move on the next slide, guys, where we are going to discuss on structuring the capital stack. So where we are going to discuss on the debt to equity, debt tenure, debt tranching is and the most important concept. Then the security package and the credit enhancement. So let's discuss on debt to equity. So in infrastructure project, typically the debt to equity ratio should have the 70 to 30 or 80 to 20, where the 70% is a debt portion and the 70 or 80% portion is a debt portion, and the 30 to 20% portion is the equity portion. NaBFID can found up to 75% prior to sectors and depend on the sectors and all these things. So the debt tenure, so in the infrastructure project there is a 20 to 25 years are the tenure of the debt, and out of which some construction phase or and then the operational phase where the principal and interest rate can receive. So match the project life sculpting repayment, and the minor cash flows will calculated and analyzed in that project. So the debt crunching, so debt crunching is how the debt will divided and how the repayment mechanism will decided. So where is the senior debt, sub debt, mezzanine debt, external commercial borrowing, bond for the post commercial operation debt, how that the bond will work, who's going to infrastructure financing. So that should be in the debt crunching, and the entire 90% of the debt portion, how much that the senior debt, mezzanine debt, sub debt, external commercial borrowing for the new debt will issue to collect the funds. Then discuss on the security package. In a security package, we are going to discuss on the mortgage of asset, hypothecation, pledge of shares, assessment of the project document and insurance. What are the assets to mortgage the assets we are going to use if there is a default in the infrastructure financing. All the assets that comes under that entity, that's the special purpose vehicle, that are the mortgage and the hypothecation and pledge of shares and assignment of the project insurance. Then the NaBFID will act as a credit enhancement. So NaBFID will be the PCG, create and debt service reserve account, escrow account, transaction and retention account, or the trust and retention account, or the viability gap funding from the authority like the National Highway Authority of India, or the Solar Energy Corporation of India, or the NTPC. So these are the government bodies that will give the viability gap funding, and the key covenants need to be write down in the concession agreement, or the interbank credit agreement, or different agreement, power purchase agreement, or the public private partnership agreement. So the cash swaps, dividend restriction to debt service coverage ratio is greater than 1.3x promoter lock, and debt service reserve account of 1 to 3 the quarters it will create the funds, and the funds will be the FD or just keep it is has. So let's move on next slide, guys. It is on the most important slide, guys, where we are going to discuss on the project monitoring in the construction phase. So what we are going to monitor, what things we need to analyze and monitor under the construction phase. So objective to ensure the timely completion within the cost and protect the disbursement. So where we do the physical progress, cost monitoring, disbursement control, compliance, and the date of commercial commencement of commercial operation, DCCO, dates of commencement of commercial operation. So the physical progress, so we will continuously charge or monthly take the lender independent engineer report. So lender independent engineer is a person who is appointed by the lender. So he will go on that project, he will do the site visit and analyze all these things, progress, current milestone, what are kind of the material, raw material they are going to use, how much the time they will require to complete that project, is that actually work or not work. So there the lender independent engineer site visit certificate which created, and it is created on monthly basis, so that we need to analyze. Then the track, monthly track, the track milestone and the concession agreement that we write in the concession agreement document, or the milestone that will achieve. Then the site visits, as an analyst we need to do the site visit and to see how much the progress of that project will go, when we can receive the funds. So that thing will do as an analyst. Then the core monitoring, so we need to do the actual versus the budgeted, how much the actually work will happen and how we are going to budget it, how much the cost they will use. So suppose we do some the 50-kilometer road construction is a 50 crore, and they will use a 60 crore. So that is a 10 crore is difference between the actual and budgetary. So we need to do analyze or tracking that thing, why that difference is there, the cost of raw material is increasing or misuse of the fund, so that is there. Then the cost overrun to be tied up with the before the further disbursement, so we need to check why the cost overrun will happen, why we are not going to track this thing, where we are going to miss to track this thing. So that's entire thing will track and analyze as an the senior analyst. So then the disbursement control, it is at the most important thing, guys. As an the lender independent engineer, we will get the disbursement request, and we need to control the disbursement, how much the disbursement we need to pay, how much the disbursement we need to keep in the escrow account or the service reserve account to keep for the further, and what are the clauses or why we are not going to pay. So we have all this clarity on the disbursement or the proportionate of equity infusion, milestone completion, and the lender independent certificate. So we need to check how much the skin in the game, how much the the sponsor involvement in the funds in that, and how much the lender will contribute it on that project. We need to check in before we disburse the funds. Then the compliance, environmental compliances clearances we required, forest clearances required, land acquisition must, RNN clearances, and land with the potential risk. So that thing should be there. Then the date of commencement of the commercial operation tracking, we need to continuously track the date of commencement of commercial operation, monitoring for delays that may impact the classification under the RBI norm, why the delay is there, can we eliminate that delay, what are the factors are impacted for these delay. So we need to track and analyze all these things in detail as an the analyst. So let's move on the next slide, guys, where we are going to discuss on the project monitoring phase in the operation phase. So project monitoring, how we are monitor the project in the operation phase, and what thing we are going to consider in the operation phase. So objective of to ensure the debt servicing and covenant compliance, and to track the early warning signals of the projects if there is the happening, so we can manage the progress of the project accordingly. So we should have the trust and retention account, we should have the escrow monitoring. So cash flow routed through the trust and retention account. So all the cash flows are routed through inflow and outflow of the cash are routed to the trust and retention account. So that account we continuously track and to review that account, to do the transaction monitoring on that account. So that will help us to check the waterfall compliance monthly. Is the payment will go in the waterfall prescriptive or not? Okay, then the debt service coverage ratio tracking. So quarterly actual debt coverage ratio versus the projected debt service coverage ratio we track, and it should not be breached the value of 1.1x trigger correction action. Then the covenant check. So we check the covenants things like debt service reserve account balances, how much the debt service reserve account have balance, and is that the paid in the last the income or the revenue generated by that project. If not, the why not project. If yes, then it's good. So then we do the insurance renewal, promoter holding, restriction of payment. So we check is that the insurance is on the expired date. So we force them to renew the insurance or to do the restricted payment and track all these things. Then the external events. So where we do change in law, let regulatory change in law, tariff dispute, RBI change the limits, RBI change their norms in the infrastructure project. So we monitor that thing. Termination event and actual cash flow. Continuously do the regulatory changes, implement the regulatory changes, track the project of progress, and then the early warning signal. It is and the most important thing, guys, in the monitoring the operation phase of the project, because that will help you to identify the weakness in the project, or to fill the gaps that will help you to prevent the losses of the huge cases. So that's why we use the early warning signal framework. So non-submission of documents, servicing delay, retailing downgrade, and the RBI early warning signal. So we need to identify there are all the 58 early warning signal which is defined by RBI, that is aligned with the banks, so that is aligned with the project. So it's that will be satisfied or not satisfied. What are the remedial action we need to check, or the non-submission of documents? We need to check all these the early warning signal. So let's move on the next slide, guys, where we are going to discuss on NaBFID specific consideration for the senior analyst. So what are the NaBFID related the specific consideration that will be for the senior analyst? So first one is a development role, credit enhancement, sector focus, environmental, social and governance integration, and RBI IRC norms. So development role, structure deal to enable bond takeout. So it's the develop the bond market, to develop the rates and win projects, to develop the markets, to help the insurance fund or the pension fund or the external commercial borrowing or the international intermediary to invest in the Indian infrastructure sector, as and the NaBFID will act as a mediator or the fund flow processor in that case, track the progress of the funds and to back that fund to the investor. So the development role to issue the bonds in the market, to severing bond, the government bond in the market. Then the credit enhancement, price and structure of NaBFID guaranteed to help special purpose vehicle assess the bond market at a rating and the good rating and appropriate rating. So it will help us to credit advancement of their entities and the sector focus. So it should be focused on the sector like energy, transportation, digital, water, social infra. Each need a sector specific model like PLFs for solar and traffic for the road. So different kind of model will require to the different sector. So each sector will focus by as an analyst and senior analyst and to set the limits and to do the sanctions the amount. Then the ECG integration. So climate risk assessment, green tagging of portfolio, sustainability link structure, to issue the green bond, to always make sure the project will put the welfare of the peoples and it will not causes the environmental effects. Then the RBI IRAC norms, so expertise in project finance prudential, date of commencement of commercial operations, SIPs and UFCI monitoring. So this kind of the monitoring will done by that analyst. So let's move on the next slide, guys. It is on the most important slide, guys, where we are going to discuss on the senior analyst and key deliverables and the skills that required for the senior analyst. So the key deliverable are bankable term sheets and credit notes with risk assessment, financial model with sensitivity and scenario analysis, monitoring report, early warning signals, alert portfolio stress testing, and the coordination with lender independent engineer, LLI and trust and retention account agent and other lenders. So these are the key deliverables that need to be done as a senior analyst. Senior analyst might be act as the reviewer of these analysis to analysis of these reports or to create these reports. So he will be make sure that the bankable term set will be created, credit note with the risk assessment. Yeah, credit appraisal note, credit note, post transaction monitoring note, pre transaction monitoring note, appraisal note that should be created by as an analyst where all the stakeholder can after reading that notes can understand the progress of projects and where that project will go. Then the financial model with sensitivity and scenario analysis. So to do the stress testing, scenario analysis, sensitivity to calculate the debt service coverage ratio, to calculate the loan life coverage ratio, project life coverage ratio, to calculate the equity that internal rate of return, to calculate the value at risk. It's all these things done by the analyst. And then the to monitor reports, early warning signal, portfolio testing, trace testing, verify the lender independent report or other language, and must have skill. These skills are very important as an analyst, and if you have these skills, guys, you have to learn by heart these skills. So the technical skills like advanced Excel, you should be bad at Excel. Your infrastructure project modeling, you should understand different kinds of modeling technique in infrastructure like debt service coverage ratio or the project life coverage ratio, loan life coverage ratio, or other things there, equity, debt, progress of the project to create the lender independent report. So that's you should understand debt splitting, debt service coverage ratio logic, and then the how much the margin and name, senior debt or the sub debt that contain in that project. Then the domain, it should understand the concession agreement, how to write the concession agreement, what are the clauses, in which section some clauses are important, what are the assumptions, how that are impacted on the projects, what are the important and non-importance of project assumptions in the perspective of lender. So power purchase agreement, trust and retention account, waterfall mechanism. Then they discuss on the finance guideline and analytical things like the identify the restructuring mitigation, read the red flags early, and identify the red flags early, and communication process to credit community and negotiation with the promoter activity. So these are the things that are the key deliverable for the senior analyst. So guys, let's move on the next slide where we are going, and it is on the key reference, and it is on the most important thing, guys, where we are going to discuss on cash flow waterfall in the trust and retention account. How the fund flow will happen if the revenue is generated that project. So how the fund flow will happen in that project? Because you can not pay first if the funds come to the equity holder, or not pay to the other things which is not necessary. So that's why we have some mechanism for the flow, the cash flow, waterfall mechanism. So in that way, fund flow will happen. So first we give the funds for the statutory due and the taxation. So whatever the statutory dues that the legal entity will have, and how whatever the taxes that entity need to pay, so we do first that thing. Then we do the operation and maintenance expenses if there are some expenses that needed to the operation and maintenance, to pay the salary of employee, to maintain the machines and their cost, all these things. Then we pay remaining funds to the debt service reserve, where we would pay the amount of that for the interest and principal to the lenders. Lender will get paid in the third, and then we paid some amounts if the amount is there. So we paid the debt service reserve account top up. So that account will maintain always the 1 to 2 quarters, and then we paid for the major maintenance reserve account, or invest some amount in the major maintenance account, because in case some uncertain event will happen and the huge amount of needed, so we can take funds from the major maintenance reserve account. Then we pay cash shop repayment, and if debt service coverage ratio is weak, so we pay and keep fines for their so to fulfill the debt service coverage ratio, and restrict payment dividend to the promoter. Lastly, we restricted payment dividend to the promoter, and lastly the funds will get paid to the promoter. So note, senior analyst must verify the trust and retention account statement monthly and do the compliance and analyze that thing. So guys, this is the end of that very interesting seminar where we are going to discuss on the financial structuring and the monitoring of infrastructure project. Once again, guys, thank you so much for attending this interesting seminar. I'm very happy to teach you. Please do like and subscribe my channel, so that one your like would get me to create and more such videos and help you guys get the better role in the development financial institutions to the big four, to the topmost organization. Once again, guys, thank you so much for attending this interesting seminar. Thanks, guys.